What's going on, my fellow wealth creators? Matty Ice here. Welcome to another training. And today we're going to answer the question, why would I pay interest to borrow my own money when I'm implementing infinite banking? And it's a good question, but it often comes from a place of just not understanding exactly how a properly structured infinite banking whole life insurance policy actually works and just the incredible benefits that you get from this. All right. So what I want to start with is because the way this question came up, I was watching a YouTube video the other day, and I just started scrolling through the comments, and this came up. This question came up, and so I want to read the comment just to give you some context, and just kind of, I guess, what typically goes through people's minds when they're starting to learn about infinite banking. Because honestly, I had this question as well, like, why does that make sense to pay interest to borrow my own money, etc. But as you learn more, the problem is, and it's the reason why I'm making this video, is a lot of people stop at these types of questions and they don't continue to learn how these policies actually work and the amazing benefits that it can bring to their lives. And I know this because I have my own policy. I implement infinite banking in my own life right now. And so when I started to answer this question and learn how these policies actually work, okay, that makes sense. That it makes sense to pay a little bit of interest to have access to my money, but it's still in this really powerful asset, right? So I want to start with, I'm going to share my screen. We're going to go through the comment just so you have some context, because there's some other really good points that I want to address here. And then we're going to go through some specific reasons why it's actually very beneficial to pay a little bit of interest to borrow your own money. So let's go. All right. So let's read the comment first. All right. So taking out a loan on the money that I put in the account, that means I'm going to be charged interest on my own money. So here's the thing. When you take a policy loan, basically what you're doing is you're not borrowing your own money. You're borrowing against your cash value. The death benefit is a collateral. So you're actually borrowing the life insurance company's money. All right. It's coming from their general fund, their general account. All right. So when you pay interest, it's going to the life insurance company. That's another point I want to make here, guys, is you don't pay interest to yourself. Okay. You pay interest to the life insurance company. All right. And we're going to talk a little bit more about that. Again, why it's advantageous to do that. But just so you understand how the policy loans work, you don't pay interest to yourself, you pay it to the life insurance company. All right. I'm really trying hard to find a reason not to cancel my plan and not put it into my kid's 529, et cetera. Let's talk about that really quick. You don't want to make a knee-jerk reaction to cancel a policy because it can be pretty expensive. You want to know what all of your options are first. If you got into a policy that wasn't structured properly, you don't have access to a lot of cash value. Maybe you can 1035 exchange it into a better policy that's more efficient. You have access to more cash value, things like that. I wouldn't, just immediately think about canceling. Obviously, speak with your licensed professional, whatnot. We're licensed as well, so if you want to have a conversation with us, you can absolutely do that. Don't knee-jerk reaction. Just cancel it because you think that it might not be it doesn't make sense to pay interest on your own money. So just be careful with that. 529 plans. You know what? Here's the thing. I'm not saying not to do 529 plans. This is not specific financial or legal advice or anything. Just my experience. Okay. I'm not a huge fan of qualified plans, 529s, things like that, because they have so many restrictions. Like the 529 plan, and when you're looking at these whole life insurance policies, there's just so many more benefits. But with the 529 plan, I'm not a huge fan of it because one, your money is locked up. Okay, you don't have access to that anymore. It has to be used for college. So what happens if your kids don't want to go to college? Maybe they want to start a business instead, go to real estate or, get into the family business. I don't know. That the money for the 529, that has to be used for college. Not everybody can qualify for it either. If you make too much money, you're not able to use a 529 plan. And it also impacts kids' ability to get scholarships, right? When you're getting scholarships or like student loans and stuff like that, if you have a lot of money in a 529 plan, that can impact their ability to take advantage of those other opportunities, right? With a whole life insurance policy, that's not the case at all. It doesn't show up on income or, it doesn't impact their ability to get student loans or scholarships or anything like that. So just keep that in mind. Pros and cons to everything, guys. You got to weigh the options and figure out what's best for you. All right. Vanguard S&P index funds without being charged interest. All right. Yeah, you might not be charged interest, but you're going to pay fees. You're going to pay taxes on it now. Again, not saying not to do it. pros and cons. Okay, with dividend paying whole life insurance, it grows tax free. You got the death benefit, like you have all these benefits. So it's kind of hard to compare those two things. If I want to invest in real estate, you can absolutely do that through your whole life insurance policy for sure. In fact, that's one of the best ways to use your policy is to borrow against the cash value, acquire income producing assets, or at least make more than what you're paying in interest. For me personally, I'm going to be getting into private lending. So my interest rate that I pay for my policy loans right now, 5.5%. If I can loan that money at 12%, I'm making a really good spread. But also, here's one of the main reasons why I am okay, and actually I want to pay interest to borrow my own money, is because my money is still growing, getting uninterrupted compound growth every single year as if I never touched it. So I'm getting the compound growth in my cash value, and over here, I'm making the difference in the interest rate I'm paying in the 12%. So I'm making money twice. Can you do that with a 401k, with a Vanguard S&P index, with a 529 plan? No, you can't, right? So it makes sense to pay a little bit of simple interest to earn compound interest. And I'm going to show you some calculators here. We'll run some numbers in a second, but let's finish up this comment here. I can use it to flip properties tax-free. You can do that with your infinite banking policy. I'm assuming they're talking about a self-directed Roth 401k if they're talking about tax-free. Not saying not to do it. Just, know the pros and cons of these vehicles. All right. Again, I don't see the advantage. And then this person down here just says it's a straight up scam, which is just stupid. You obviously just don't understand how these policies work, right? So let's get into some specific reasons. I want to go through just a couple of specific reasons why I want to pay interest to borrow my own money. And then I want to show you some numbers here. We'll look at some calculators, all right? So here's the way I think about it. So I'm a business owner, and obviously with running a business, there's expenses, right? So I pay, $500 a month for a piece of software to run part of my business. Now you might think, well, wow, that's a lot of money to run or for like a piece of software, right? But if it makes me $10,000 a month, then why would I not do that? Or $5,000 a month, whatever, right? So it's the same concept where when I borrow against my policy to acquire an asset or to invest in my business or whatever, to me, that the interest I pay is a very small price to pay. It's a small cost of doing business. It's a small cost for all of the awesome benefits that I get with this policy. Because again, also when we were reading that comment, he's talking about, why would I do this just to borrow my own money? That's not the only thing you're doing, right? You get so many other benefits. You get safety. These mutually owned life insurance companies are some of the safest, the best at risk management in the world. They're some of the safest companies in the world, way safer than banks, in my opinion. If you just look at the history of Wall Street, go back to the Great Depression or the 2008 financial crisis or the savings and loan crisis. What were the main companies that were failing? Banks. Like 9,000 banks throughout the Great Depression. I think it was a couple thousand in the savings and loan crisis. In the Great Depression, I think it was like $140 billion of people's savings just gone, lost when all these banks went under. Like, I just can't even imagine that. And imagine putting that in today's dollars. That's probably trillions of dollars, right? But yet, like the company that I have my policy set up with, they paid a dividend through the Great Depression. All the years through the Great Depression, they've never missed a dividend payment. So you get safety, you get liquidity, access to your money in the form of these policy loans, uninterrupted compound growth. It's so powerful because, again, you're borrowing the life insurance company's money, not your own. So your money, the cash value, continues to grow uninterrupted every single year, guaranteed rate plus whatever dividends get paid out, right? So you're making money twice here. If we use the example that this person mentioned about investing in real estate, you're earning your uninterrupted compound growth, but you're also acquiring an income-producing asset. Yeah, you pay a little bit of interest to do that, but why would you not want to make money twice and also acquire this income-producing asset? It increases your net worth, it increases your cash flow, right? Like, to me, that makes sense. When I learned and heard it that way, that makes a lot of sense to me. All right, so it's a cost of doing business to do all of the things that you would normally do in a much more efficient way, right? You pay simple interest while you earn compound interest. Now, this is where I want to show you the calculator here. Let's do the calculator here. This just kind of blew my mind when I learned this, guys, because it seems really simple when you see the numbers, but it's not something that we're taught, right? And these are like, to me, these are the really important financial principles that we should be taught, especially when we're younger, but we're not. And it's really frustrating. But hopefully, helps right now. So if I were to ask you, if you were to, same dollar amount, we're going to use $28,000 for our example here. If you were to pay 6% interest on a loan, but earn 4% in an account over here, at the end of 5 years, which one would have a higher dollar amount? Now, when I was first presented that question, I immediately said the one with the higher interest rate. Obviously, that just makes sense, right? Not true. The difference is, this is the incredible difference of simple interest versus compound interest. And this is one of the main reasons why it makes sense to borrow and pay interest on your own money, even though it's the life insurance company's money. All right, watch this, guys. So I recently used my policy to purchase a vehicle, paid $28,000 for it. So I took a $28,000 loan against my cash value, okay? And if we were to set up an amortization schedule as if I were to borrow from the bank, all right, 5 years, 6% interest. Now, also, too, this is another benefit of borrowing against your own money. Interest rates are pretty high right now. You know, when I was originally quoted for loans on getting a vehicle, it was upwards of around 10%. I have decent credit. My interest rate on my policy loan is 5.5%. So you can actually save a ton of money in interest depending on the economic conditions currently. So keep this in mind. That's another benefit. But anyways, let's say I got it at 6%. All right. If we calculate that out, at the end of 5 years, I will have paid a total of $32,479. Okay. Now watch this. If I take the same dollar amount across the same amount of time, lower the interest rate of 2 percentage points to 4%, but I compound it every single year. Watch this. I actually end up with more money than what I paid with the loan. This is one of the main reasons why it makes sense to borrow and borrow against your own money, pay a little bit of interest, because it continues to grow uninterrupted every single year. Versus the policy loan, when you're making payments on it, it's simple interest. So the interest rate is being applied to a lower and lower and lower balance, while the compound interest is being applied to a higher and higher and higher balance. So you could earn a full 2 percentage points lower than the interest rate you're paying and still come out ahead. Tell me where that doesn't make sense, guys. And if we need a little more clarification on that, drop some comments down below. Let me know. But when I saw this just blew my mind, because it seems very obvious that if you're paying a higher interest rate, but you're earning a lower interest rate, that you're going to pay more than what you would earn. It's not the case. It depends on what's happening with the money. So really, really powerful stuff. The last thing that I guess we'll finish up with, a couple more benefits. Again, I really want to make sure that I address all the issues around this question. So another reason that this is beneficial is, let's say you don't have good credit. Let's say you're making money in your business, you make a decent income, but maybe you fell behind a little while ago, and you're back on your feet, but your credit is not great, and you want to invest in real estate, or you want to purchase a vehicle, whatever, but your interest rate is really high because your credit's not great. Borrow against your policy loan. And so, just like me, instead of paying 10 to 12% interest on a bank loan, I pay 5.5% interest to the life insurance company instead, while I'm earning compound growth. Okay. And here's like a small side benefit too, to kind of think about, just think about this a different way, is when you pay interest to the life insurance company, because you are a part owner, and that's the way these mutually owned life insurance companies work, is when you have a policy, you're a part owner in the company. That's why you receive the dividend. Okay. Well, when you pay interest to the company, that is a small profit center for the company. So technically you're contributing to the profitability of the company, which is going to come back to you in dividends anyways. Now, you're not, again, I want to be clear here, you're not paying yourself interest, you're paying interest to the life insurance company, but you're technically contributing to the profitability of it as well. So that's something to think about. Also, here's an interesting way to think about this, guys. This is so powerful. It's where we're recycling our principal. Now, check this out. Okay. If you were to borrow, in my situation when I purchased a vehicle, if I were to borrow that $28,000 from the bank, every payment I make in principal and interest, plus the down payment if they wanted one, is gone forever. I will never see that money again. If you try to go to the bank, let's say I paid for 6 months, and I call the bank up and I say, hey, of all the payments I've made, the principal I paid you, something's come up, I want to borrow that again. Will you give that back to me? Can I get access to that, please? they're going to look at you like you're crazy. That's never going to happen. You would have to apply for a different loan or whatever. You'd have to qualify all over again. When you make payments to the bank, that's the bank's money. It's not yours anymore. Versus when you make payments on your policy loan, those principal payments immediately show up in cash value. And all the payments that I've made on my policy loan so far, minus the accruing interest, I now have access to again. I can use that money again. So basically, do you want to pay money to a third-party bank, or do you want to put money back into your own bank? Guys, again, when I learned how this asset works, it's just mind-blowing how many benefits you get. So if we look at just weigh the pros and cons of different types of assets, different vehicles we can use to build, grow, protect our wealth. What are the pros and cons? What are the benefits that I'm getting here? Another benefit that people often just kind of forget about is the death benefit. Not just that it's a tax-free payment to your family if you were to pass away unexpectedly, you're taking care of your family. Also, if you get diagnosed with terminal illness, chronic illness, or something happens, like a specific medical condition, it happens, you have access to a large amount of that death benefit to help protect you and give you that kind of long-term care protection without needing to qualify for long-term care insurance. I'm not saying not to have long-term care insurance. I'm saying pros and cons. Know the benefits. Know what your money is going to get you. If I put my money into this vehicle, what are the benefits? What am I getting out of it? Versus if I put my money in this vehicle, what am I getting? And then you weigh the pros and cons. But listen, guys, that's why I'm really adamant about this stuff. That's why I started the channel, because I know how powerful this infinite banking concept is. When the policy is structured right, you use it correctly. To me, it was a no-brainer once I really understood how it worked. So, if you're on the fence about it, whatever questions that you have, keep researching. And at the end of the day, you hear all these amazing benefits that I've talked about. If it still doesn't resonate with you, if it doesn't make sense, that's fine. But it's important for you to have all the information, all the facts. Like, how does this thing actually work? To me, it makes sense to have my money continuously compound, uninterrupted, tax-free, okay, while I borrow against it. I pay a little bit of interest, but then I loan it at 12%. So I'm getting the compound interest over here. I'm getting the spread over here, which is massive. It has a pretty big spread, 5.5% to earn 12. Now I'm making money twice. I just don't know on what planet that does not make sense and why that would not be beneficial. So I think that's it. I've gone through all of my bullet points there. Yep. I think that's about it. If there's something I missed or something you still need clarification on, please drop it down in the comments and leave some feedback. I'd love to hear what you guys think about this, what your experience with this kind of stuff has been. So far, my experience has been really cool, and I'm excited to continue sharing it with you guys. So with that said, I'll go ahead and wrap up. Hope you guys are crushing it. I'll talk to you in the next one. To your success. Matty Ice is out.